Hey guys, Felipe here. So as you know, I'm here to keep you up to date with current market news, teachings, and tech. So in this video, I'm going to be talking about one of my go-to strategies in terms of investment and looking for opportunities, which is our arbitrages, right? So I'm going to go ahead and jump right into that. So there are many forms of arbitrage depending on what kind of opportunities you're looking for in the market. For example, there is market arbitrage, which occurs when an investor buys a security on one exchange and simultaneously sells the same security on another exchange. This enables the investor to take advantage of small price deviations between the exchanges. For example, the investor may purchase XYZ on the New York Stock Exchange for $19.21 and simultaneously sell it on a regional exchange for $19.23. Although 2 cents doesn't seem like a lot of money, our arbitrageurs historically moved large blocks of securities. So let's say they traded 100,000 shares. This would create a $2,000 profit for the arbitrageur. That's a hard word for me to pronounce, but that they would usually make the money on the large shares of securities, right? And then there's risk arbitrage, which is one I'm always on the lookout for. I made some prior videos on some opportunities on these, which was the acquisition of Activision by Microsoft and the acquisition of Black Knight Mortgage Technology by ICE, which is the owner of the New York Stock Exchange and all the other exchanges. So risk arbitrage is another form of arbitrage that is used in a merger acquisition scenario. The risk arbitrageur buys the stock of the company that is being acquired and sells short the stock of the purchasing company doing the acquisition. Typically with these, I just buy the company is going to be acquired, not so much necessarily short the acquisition company, but that's pretty much the strategy for risk arbitrage. And then now there's arbitrage with convertible securities. So there's also not an arbitrage opportunity with convertible securities. The arbitrageur would purchase the convertible bond or preferred stock, and if the market conditions were favorable, they would convert to the common stock and sell on the open market at a profit. This would happen when the common stock was trading above parity. So for example, let's say the bond was purchased at $1,100 and the conversion ratio was 40 stocks for the one bond, right? This would make the parity price of the underlying stock $27.59. So 1,000 divided by 40 equals $27.50 because $1,000 is the bond par value, right? If the stock was trading in the marketplace at $27.60, the investor would make the 10 cents difference, right? A share, if they bought bond and converted and sold the stock in the market at $27.60. Again, the 10 cents doesn't sound like much, but again, our arbitrators move large blocks of securities to make their money. Also, and then this depends on the risk arbitrage, right? Is it a all cash offer or is it a all stock deal? That kind of has a huge influence on the percentage that someone can potentially make on the investment. For example, all stock deal means that acquiring company isn't forking over code hard cash to buy the target company. Instead, they are offering shares of their own stock to the target company's shareholders. Think of it as a trade ownership in one company for ownership in the other. There can be reasons for such a deal. Perhaps the acquiring company doesn't have a mountain of cash readily available. Maybe they believe their own stock is undervalued and represents a better long-term play than a simple cash payout. For the target company's shareholders, it's a decision that requires careful consideration. They are essentially betting on the future of the acquiring company. The acquiring company stock takes off, they could end up with a windfall. However, if the stock price sputters, they might be left wishing for the security of a cash payment, right? Which typically I prefer the cash route. So in the terms that is a cash buyout, merger acquisition, you would use the traditional share price calculation, which is what would the estimated stock price would be. It's just basically market capitalization divided by shares outstanding. And then in an all stock deal impact, you would use the exchange ratio, which is typically the exchange of X amount of shares of the acquiring company to the shareholders of the target company that's going to be acquired, right? So that's kind of how that works. And before I kind of give an example in the actual market right now, this is a pretty awesome quote I recently came across with by Henry Ford. What we need is some financial engineers. Makes a lot of sense because a lot of people that seem to be managing US, markets are not doing a great job. So let me just jump over here. And then, so I've noticed that in the oil industry, there's been a lot of acquisitions as of late. For example, ExxonMobil recently acquired Pioneer Natural Resources, and Chevron is currently in basically a deal to acquire Hess, right? So there's been a lot of acquisitions in the oil industry as of recent. Another one that's been announced is ConocoPhillips agreed to acquire Marathon Oil Corp in a $22.5 billion stock deal, extending a major buying spree in the US oil and gas industry. This is kind of what I was explaining. ExxonMobil basically bought out Pioneer Natural Resources recently. That was a good arbitrage play. Although as soon as the announcement came out, stock kind of blew up close to the acquisition price. And so there's been a lot of acquisitions going on in the oil industry, which basically tells me that these oil companies are predicting that there's going to be a lot of demand in the future for oil, right? So basically the key details of the acquisition between ConocoPhillips and Marathon Oil is that Marathon Oil shareholders will receive 0.2550 shares of ConocoPhillips common stock for each share of Marathon Oil common stock. This represents a 14% premium to Marathon's oil's closing share price on May the 28th. Currently, there isn't much of a play there because the stock is pretty much at the acquisition level, which is approximately $28.15. But there's always, opportunity to keep an eye on it, because if the FTC were to, get involved, it could shock the current holders of the stock to exit, right? Which might create an opportunity to jump in. Another example is the Hess acquisition that is being acquired by Chevron, which the acquisition price, and this is a cash deal, which is kind of the ones that I kind of, like to look for. So Hess is currently at $152, and the acquisition price by Chevron is said to be $171. So there's a little bit more of a position play here in terms of a risk arbitrage than there is currently with ConocoPhillips, right? So those are just some examples of how these arbitrage opportunities look. So if that made sense, but yeah, with that being said, if you liked what I shared with you and would like to hear more, Just stay tuned for more videos in this series. I appreciate you guys for your time, and I will talk to you on the next one.